Ladies and gentlemen, good day and welcome to Radiant Cash Management Services Q3 FY2024 conference call hosted by Antique Stock Broking. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sohail Halai from Antique Stock Broking. Thank you, and over to you, sir.
Thank you, Ria. We welcome you all to 3Q FY24 earnings call of Radiant Cash Management Services. We have with us today Mr. Colonel David Devasayam, CMD, Mr. T.V. Venkataramanan, CFO, Colonel Benz, COO, Mr. Alexander David, GM Operations, and Mr. Muthu Raman, Director, Advisor, Strategy and Investor Relations. Without further delay, let me hand over the call to David, sir, for his opening remarks, post which we can actually start the Q&A. Over to you, sir.
Thank you very much, Sohail. Good morning, ladies and gentlemen. Thank you for joining us today for Radiant's investor call. Before we get into the details of the performance for this quarter, I want to recall the strategic roadmap for the company that I shared with you in our last call and how we aim to build a stronger, more robust business, building shareholder value over the coming years. I'm now sharing the 4 key areas of our focus and the progress we have made in each of them. First, optimizing the core business for maximum efficiency and profitability. We have taken conscious measures to leverage our network over nearly 14,000 PIN codes to improve the profitability of our core business. Secondly, diversifying through adjacent business opportunities. We have made good progress in our diversification efforts in diamond, bullion, and jewelry transportation business, as well as in the integration of a recent fintech acquisition, Radiant Case Money. Thirdly, enhancing customer experiences with a cutting-edge digital platform. That's a physical and digital composite platform that we have now created. We have rolled out Radiant Insta Credit in select markets and have got excellent acceptance from the market. Lastly, we are committed to expanding our reach and technological capabilities. We have added more PIN codes and locations, as well as added 38 new names to our client list in this financial year. These initiatives reflect our dedication to sustainable growth and innovation. With a clear roadmap, we are poised for success in an ever-evolving market, creating long-term value for our investors. Our performance for this quarter ended December 31, 2023 is better than the previous quarter. Total revenues was rupees 1.01 billion, that is over 101 crores, registering our first ever quarter to cross the billion mark. As mentioned in the last quarter, drop in volumes in the e-commerce logistics and NBFC sector has resulted in muted revenue growth. We clocked 4.5% growth in cash handled in this quarter over the same period the last year. The core business profitability has improved in the quarter. Thus, despite higher costs due to our recent foray in the diamond, bullion and jewelry segment, our EBITDA margins improved to 17.5% in this quarter as against 15.9% in the previous quarter. Our priorities are to restore the revenue growth to 17 to 19% in the medium term through addition of varied clients and offering wider range of technological solutions to our clients. The potential for growth is enormous, as the doorstep banking services are still in a nascent stage in India. We are excited about the journey ahead and the potential for growth and success. As always, we remain committed to providing transparent updates on our progress and answering any questions that you may have. With that, I now hand you over to Mr. Muthuraman, our Head of Strategy, to take you further down this presentation.
Thank you, Colonel. Good morning, everyone. Thanks for joining us on this investor call today. I'll present the company's financial performance and key performance indicators for the quarter and 9 months ended December 31, 2023. Talking about the business performance, during the first 9 months of the financial year, we handled 1.26 trillion of cash, representing 7.1% growth over the same 9-month period last year. During this period, we added 38 new clients, 84 new end customers, and 4,266 new retail touchpoints. We witnessed strong growth in BFSI segment, organized retail, and petroleum sector. As mentioned in last quarter, our overall growth was muted due to subpar growth in the e-com logistics sector. The management is taking specific measures to address this segment. Our recent launch of Radiant Insta Credit is being received very well in the market and will help increase customer stickiness as well as increase our foray into newer segments and geographies in an accelerated manner. Coming to the financial performance for the quarter, our revenues for Q3 were 1.01 billion, representing a sequential growth of 6%. And as Colonel mentioned, first time crossing a billion mark in a quarter. EBITDA margins for the quarter stood at 17.8%, an improvement of 180 basis points over the previous quarter. This is despite significant costs incurred in the growth initiatives the company has undertaken, particularly in the diamond bullion jewelry segment, the results of which are yet to bear fruits. Cash from operations segment has also grown at a healthy pace of 44%, though on a very small base. For the profitability in this segment is still not reflected fully as we are still in the deployment phase. As can be observed, expenses in DVJ and cash from operations are in the nature of investments and prerequisites for strong future growth of the company. We expect the margins to improve further in the coming quarters because of the measures taken by the management. In terms of segments, BFSI and organized retail reported robust growth of 23% and 19% year-on-year respectively. Both existing points as well as healthy new additions contributed to this growth. The petroleum sector, which saw a slowdown in FY23, has recovered well and reported 67% growth over the same quarter last year and 2.4% sequentially. We expect the momentum to continue and the segment will grow at a higher than average level in the next few quarters as well. E-com logistics showed 29% negative growth due to a combination of pricing pressure and the shift of clients to alternate mechanism for low volume points. Radiant is developing unique fintech solutions to specifically address this segment, which will help us regain our preeminent position in this segment over the next few quarters. The return on capital employed on an annualized basis was 25% for this 9-month period, as against 30% in the past. Our investment in cash funds to the tune of almost 100 billion for this 9-month period, and the drop in EBITDA margins as discussed earlier have contributed to this reduction in ROCE. ROE for the month was 20% on an annualized basis. To summarize, the quarter has seen a recovery in revenue growth and profitability over the previous quarter, indicating the underlying core business model is well intact. Significant investment in manpower and assets have been made during this period. With the new initiatives that as highlighted by CMD in his remarks, we are building a new long-term levers for growth with a more diversified revenue profile and robust profitability. I now hand over the mic to Mr. Alexander David to talk about the developments in Ace Money, our recent fintech acquisition.
Thank you, Mr. Muthuraman. Good morning, everyone. Our diversification into the fintech sector with the acquisition of Ace Money, now called Radiant Ace Money, has been very promising and has given us ample opportunities to grow in the near future. While the market is reasonably well penetrated in the major cities and tier 1 cities with several players, we are excited with the encouragements we have been witnessing from the tier 2 plus markets. Currently, all the banks and fintechs have achieved only around 45% penetration of over 2 crore available merchants in terms of POS machines. This indicates ample opportunity in the hinterland. The creation of digital banking infrastructure in the hinterlands is also well backed by the government. There are 2 key opportunities I would like to highlight today. The first, access to hinterland and tier 3, 4, 5 plus cities. Most major fintech organizations depend on distributors for reaching their products throughout the country. While these are easier to do in major metros, penetrating the hinterland is a challenge. This will require fintech companies to recruit and train new workforce along with the distributor. In most cases, lion's share of the commissions are given to the distributors for maximum use of their products. RCMS, the parent company of Ace Money, has more than 7,000 plus personnel in over 14,000 plus PIN codes, including tier 5 plus locations. These resources have basic training in use of mobile application and with the additional guidance can prove to be our distributors, which would result in Ace Money having an earning advantage over its competitors. This provides accessibility and cost-effective deployment of the technology to the balance 55% of the available market. The second opportunity is cash management services. Today in the market, there are very few organized players providing CMS services in addition to fintech products. One of the major current requirements in the hinterland are CMS services for cash disposal and delivery. This is something we plan to leverage in the coming months. So what's our plan ahead? Over the next 2 years, utilizing our resources to build a comprehensive network of business correspondents throughout the country, to build a brand with the USP being providing CMS services as a value add in addition to fintech solutions, to integrate fintech solutions with our CMS and develop products for direct clientele. Digitization of CMS services using fintech solutions looks to be very promising for us. Thank you.
Thank you, Alexander. I think now we'll open the floor for any questions that may be there.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all participants, you may press star and 1 to ask question. First question is from the line of Dhruv Mukesh Bajaj from SmartSync Investment Advisory Services. Please go ahead.
So thank you for your detailed explanation regarding our performance. My first question was that you have earlier guided that the new pricing model led to poor margin show in Q2 and that the management expected drastic improvement in Q3 and Q4, whereas cash handling volumes are generally higher. However, numbers indicate otherwise. So can you please guide us as to what was the reason behind this and when can we see some margin improvement?
Yeah, thanks for the question, Dhruv. As I mentioned, the margins have improved from Q2 to Q3 despite a substantial increase in our investment in RVL. We clocked roughly about 1 crore of revenues in RVL and incurred costs roughly in the range of about 4.5 crores. So removing that, we will see roughly about almost a 5% improvement in EBITDA margins in the core business. And we do expect a further improvement from here in our core cash management business, as we have taken measures, as I mentioned, in the e-com logistics segment, which had depressed our top-line growth. So it's a combination of RVL investment and muted revenue growth. That is what is reflected in the current margins. They're taking measures to address both of these.
Okay, sir. So the current guidance for FY25 stands at 20% plus. But can you please give us some sense as to the margins that we can expect going forward, and what will be the key drivers in the near term?
So Colonel mentioned that 17 to 19% top line growth, and we are expecting that the margins will restore to previous year levels soon in the next few quarters.
Okay. And sir, we have seen a 760 basis points drop in the margins year-on-year basis. So can you please quantify as to how much of that is due to operating deleverage, the new DVJ business, and new pricing model? So we can get a sense that what is leading to this fall.
I just explained that vis-a-vis the previous quarter, almost a 5% improvement in EBITDA margins have happened. If you see over 9-month period, again, RVL would have accounted for more than half of that drop in margins, and the rest of it will be because of the muted revenue growth.
I would like to add on to what Mr. Muthuraman has said. And this, we are now investing deeply into allied areas like diamond bullion and jewelry movement, and the recent acquisition of a digital banking solutions platform, because we see the close synergy that it has with retail cash management, and to leverage our existing network and optimize it so that over time, the revenue generation becomes far more positive, and it becomes, so this is a period of investment and a gestation period that we are currently going through. That I would like to emphasize at this point.
Got it, sir. That is very helpful. And sir, if I can just squeeze in another question, that I just wanted to understand that our PPE and capital work in progress has increased significantly in the current 9 months. So can you please give us a breakup in terms of where the capex was incurred? Since I was seeing the vans have increased by around 30 and our safe has increased by 5. So I was unable to gauge that what is leading to this high capex cost.
Investment in CapEx is mainly on account of cash van vehicles purchased during the current year. We have purchased about 200 vehicles during the current 9 months.
Okay, sir. Okay, that's it from my side. Thank you.
Thank you. Next question is from the line of Sonal Minhas from Prescient Capital Investment Advisors LLP. Please go ahead.
Hi, sir. Sonal Minhas. Am I audible?
Yes, please.
Sir, I wanted to understand like the unit economics level or some understanding of the fintech operation. What is the margin profile of this business? Is it at par with what we have, or if we keep on investing in that business, it will be at par with our current business over time? Because I think the general understanding is that that segment is underserved largely because commercially it doesn't make sense. So what is fintech and your cash management service blended with the fintech doing to make this particular vertical economically viable? If not now, maybe 1-2 years hence, essentially. So that will be great. Just understanding that. That's the first question.
As you know, that we are already deployed in over nearly 14,000 PIN codes at this point of time. The current fintechs which are operating in the market do not have feet on street, while we have a detailed presence with our people and qualified people at all these locations. Now, I'm talking about a great deal of synergy that exists with cash management services and we see a lot of opportunity for both cash pickup as well as cash delivery requirements, which can come up in Tier 4, Tier 5 plus locations where we have a strong presence. So that is how it cannot be just compared with the normal current fintech model which is going on, but we can see far more value creation in the model that we are moving in a synergized manner.
I understand that, sir. Sir, if you could quantify this particular argument with some numbers, what is the incremental cost of picking up, let's say, money from a kirana shop which has decent money throughput, and how much margins do you make or the fintech makes basically which you required from this particular? This will help us just understand this. Just need some quantification.
Sure. See, the current fintechs, I don't think offer CMS as a solution for picking up cash from these in any meaningful manner. What they provide is actually the point of sale machines, micro ATMs, mobile apps, QR codes, through which they enable the retail to transact digitally and earn some commissions. So where Radiant has that advantage, like Mr. Alexander mentioned, we can offer that both cash delivery services for the micro ATMs as and when they run out of cash, and cash pickup mechanisms from those business correspondents. Is the costs or the margins for the cash pickup and cash delivery that we will be offering will be done through Radiant, and the margin profiles will be similar to what we are doing in our existing business. We are not offering it at very low, any different rates from what we are offering to any other retail outlet. At the same time, the unit economics for Ace Money, Radiant Ace Money as a subsidiary, will depend on the scale of its rollout. So we hope to achieve break-even over the next couple of quarters. Thereafter, as you can understand, that is a commission-driven business, and some part of the commission is spread across the value chain, and balance is retained by the originator. So in terms of gross margins or EBITDA margins, it may not be comparable. The levers are very different in that business. But what we are expecting is that the return on capital that we deploy in that will reach Radiant's level or even exceed it over the next couple of years. Okay.
And sir, what is the throughput level of a kirana shop for it to be serviceable and being a potential customer, if I may understand? Because there are many kirana shops, some are big, some are small. There are some shops which have high cash throughput. What is the target segment of customers, kirana shops or small shops, in terms of cash collection, which basically seem addressable? And where are we conducting this pilot? Is it a southern state? Is it a special micro market we are conducting this? Just explain that, please.
So, as I mentioned, there are two parts to it. There is no minimum threshold for the fintech rollout, which is rolling out POS machines, rolling out micro ATMs, etc. There is no threshold. There's a significant government support also for building that payment infrastructure. So even roadside vendors, anybody who is not there's a huge population of people who have got onto the banking system but not yet got onto the digital banking segment. So the growth on the fintech part of it is contingent or is dependent on that level of under-penetration there. In terms of our pickup, where it will make economic sense for a kirana stores, will be, as in a sense, in a normal Radiant cash management, we start with a threshold of about 50,000 rupees of collection per day. In Tier 3 plus locations, where together with Yes Money we are rolling out, this threshold would be even lower, maybe 25,000 or so.
The point, just to add on to what Muthuraman has said, we have already a dense network across the country. How you monetize that network is by adding additional pickup points to that existing network. On the same route, when we pick up more points, so therefore the volume of cash from that individual outlet may not make any difference, even if we say give them a slightly cheaper value, because it's on the same route. And it's just one more stop for us to pick up, how to deliver cash.
Understand that. Can I ask another question, or I can come back in the queue as well?
You can continue.
Sure. Sir, also just wanted to understand the e-commerce business in which I think margins are under pressure and the contracts are being renegotiated. Do you see this, and it's difficult to answer, but do you see an underlying trend of this happening with you in financial services and other sectors as well? Because there is a line that analyst community here can draw and say this is going to trickle down to other segments as well. So just want to understand that too, that in general our contract getting renegotiated as you are scaling up and becoming a meaningful part of the expense of an e-commerce company, or cash any which ways is getting reduced in collection for an e-commerce company, maybe for banks going further. So just from a 2-3 year out perspective, just trying to understand this.
Yeah. I'll answer that. So I want to make a distinction between e-commerce and e-commerce logistics. This is particular only to e-commerce logistics and not in e-commerce. We have reported robust growth in our e-commerce business.
Yes.
In e-commerce logistics, we are witnessing this only in very remote locations where unit volumes are very small. Can't get much details into this because that is competitive information in nature. But we are developing technology solutions to address this issue, and the erosion is already stemmed. So we are seeing marginal sequential growth as well. So we expect it to restore back to our previous levels over the next 2-3 quarters.
Got it, sir. Okay. Thanks a lot for answering my question, sir. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. Next question is from the line of Ganesh Nagarsekar from Bharat Bet Research. Please go ahead.
Hello, sir. So 2 questions from my side. First is on the retail touchpoint front. We've added just about 1,260 odd retail touchpoints this quarter, and this number has been going down sequentially over the last few quarters. And we've guided to a much higher range of around, say, 1,000 odd touchpoints a month. So just wanted to check the reason why we are kind of growing materially slower, and what the guidance for this would be going into FY25. And the second part is on the DBJ front, to understand the competitiveness of our service versus the unorganized Angadia market, and what would be the broad drivers of market share gain, given that we kind of operate under a regulatory construct where we have, say, a member, RBI regulated team and stuff like that, whereas the unregulated market works with a much leaner structure. So wanted to understand our competitiveness in the DBJ and how we broadly plan to gain incremental share there.
Yes. Okay. In terms of point addition, it is a direct reflection of what I spoke, as in specific segments, specific sub-segments. The revenue growth is fairly correlated with our points growth as well. And as I said, in BFSI and in organized retail, we have had excellent growth. The drop is the lower growth is on account. It's a net number what we are talking about. The gross additions have still been fairly in line with the slightly lower than what the guidance that we had indicated. But because of the churn and drop in the e-commerce logistics segment, the net additions have been on the lower side. As I said, corrective measures are being taken, and our guidance for the future at 17 to 19%, what TMD mentioned, should be achieved through a combination of both additional points as well as same point growth as well. On the DBJ segment, there is the mechanics of operations between organized and unorganized is very different, and the So we are focusing on the mechanics that the existing players offer in the organized segment, and it's an extremely underpenetrated segment. I don't know if, like Colonel mentioned during our last call, there are more than 1 lakh plus BAS registered jewelers, and the existing players cater hardly to a few thousands of them. So it's a large unpenetrated market, and with our strong on-the-ground presence till that last mile, we believe we'll be able to offer a much better quality of service at competitive rates to the jewelers, so that they migrate to, so that we have a right to win of those incremental market share.
Okay. So on the BBJ front, you're saying we are kind of cost competitive versus not only the organized segment but even the unorganized as well, or are we primarily competitive versus the organized itself?
Okay. So as we understand, the difference between organized and unorganized is, the difference between organized and unorganized is not because of not so much the pricing difference.
Okay.
Yeah. It is to do with billing, GST, additional costs, etc. So we are definitely competitive vis-a-vis the existing players, and we see the unit economics there. Again, it is like in RCMS business. It's a high fixed cost and a high incremental gross margin business. So to that extent, we believe once we reach that critical threshold volume, we'll be fairly competitive to take healthy profitability.
Understood. And also, if you could provide a kind of broad breakdown between on the touchpoint front, the gross addition for this quarter, if you could provide the number, please.
Sorry, we don't have that ready, but as I said, it is slightly lower than the incremental numbers that the guidance numbers that we have indicated. Probably about ballpark in the range of about 2,500 to 2,600 for the quarter.
Okay, understood. Thank you, sir. That's it from my side.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Aditya Shroff from InCred Asset Management. Please go ahead.
Yeah. Hello, good morning, sir. Am I audible?
Yes, please.
Hello. Yeah. So, sir, my first question was, so currently, regarding top-line growth, we are currently growing at around 8 to 9% on a year-on-year basis, versus the competitors will continue to grow at 19 to 20%. So is there any chance that we are losing market share?
No, there's no, I mean, you see, when we talk about the competition, they're also into other segments where we are not present. We are largely into retail cash management, and there, if you see the growth, it is the same as far as the competitor is also concerned. So, I don't think that there is any change in the growth. I mean, now, currently, as I said earlier, we are looking at, this is a gestation period. We are deeply investing into other aligned sectors while we continue to strengthen our core business, and we are focusing on continued growth in this segment as well. So, the investments that we are making now in diamond bullion and jewelry, which is currently actually impacting our numbers, is all going to turn into a positive thing